Hello, Week 8 Fraud Project. During the 1990s, Richard M. Scrushy, the former CEO of HealthSouth Corporation, engineered many acquisitions of rehabilitation clinics, outpatient surgical care operators, nursing homes, and other healthcare companies. Mr. Scrushy had been a respiratory therapist who spotted a niche in the healthcare market and utilized his entrepreneurial talents, marketing skills, and super salesmanship to set up and run what became the third largest publicly held company in Alabama. Eventually, HealthSouth became the largest provider of ambulatory surgery and rehabilitative healthcare services in the United States, with 1,700 facilities and 51,000 employees. The accounting fraud at HealthSouth was, by any standard, both enormous and complex. Its concealment over the course of nearly 7 years required considerable effort and, in some cases, just plain luck. Stated most simply, the fraud was accomplished by making over $2.7 billion in false or unsupported entries in the company's accounting systems. These improper accounting entries, made for the purpose of inflating HealthSouth's earnings, took two principal forms. One, exaggeration of reported revenue, primarily through reductions to contractual adjustment accounts, and two, failure to properly characterize and record operating expenses. In 1996, during the second quarter, HealthSouth began what was to become a systematic pattern of reducing contractual adjustments, i.e., narrowing the gap between standard charges and anticipated reimbursements. For example, they would charge $10, but the reimbursing agent would be $5. When you narrow the gap, they say, oh, we're going to get $9 for that $10 of billing, even though that's not the way it works. This practice continued without interruption in every reporting period through mid-2002. At the same time, the company reclassified a number of operating expenses to make it appear as if the expenses never occurred. The income statements also required balance sheet manipulations. These manipulations resulted in unsupported entries that affected virtually all of the company's balance sheet asset accounts. For the most part, improper accounting entries were made after a first-run consolidation, rather than in conjunction with proper entries made in the ordinary course of the company's daily operations. The improper entries shared other characteristics as well. They typically were in large dollar amounts, routinely carried generic, non-descriptive explanation, and often were not accompanied by contemporaneous documentation or other support. Many were extraordinarily long, often exceeding 200 lines, and were entered into the accounting system through external uploads. Improper entries frequently were booked to intercompany and corporate suspense accounts and otherwise affected accounts not normally associated with one another. Many entries were self-reversed during successive reporting periods. Finally, many improper entries contained designated letter prefixes, and many of the employees who recorded them were at least generally aware that they were incorrect or unsupported. Unexplained revenue increases and expense reductions, which improved the earnings of individual facilities, became so institutionalized at HealthSouth that they were referred to by corporate accountants as management entries, and by operations personnel as gifts, pixie dust, fairy dust, or candy. To account for assets that did not exist, and thus would not have been recorded in HealthSouth's payable system or processed in its general ledger system in the normal fashion, fictitious assets were added to the fixed asset list during monthly reconciliations. Given the method by which non-existent fixed assets were allocated to a particular facility's books, some entries had dollar values exceeding the cost of any asset the facility would have been likely to acquire. Concealing the overstatement of HealthSouth's reported cash balances by approximately $374 million presented similar challenges. Receipts from the company's nearly 2,000 bank accounts were swept daily into a corporate consolidation account, known as a 1015 account, before being transferred to a corporate disbursement account. Funds swept into the 1015 account were recorded through a general ledger entries based on monthly reconciliations prepared by the company's cash department. Between 1999 and 2002, a former employee responsible for preparing these reconciliations regularly misstated either the 1015 general account ledger or the transactional activity in that 1015 account. Essentially, it was a place in which fraud could be perpetrated and then sent back to the company as, quote, the real numbers. Although HealthSouth never established a formal employee incentive compensation plan, it paid discretionary bonuses of more than $78 million between 1999 and 2002. By means of improper accounting entries, the company failed to record nearly two-thirds of this bonus expense. Again, improving its bottom line and improving its reported income by not allocating or accounting for the bonuses that they paid out. Between 1998 and 2002, HealthSouth's reported income was affected by transferring a variety of current expenses to property, plant, and equipment accounts, reclassifying those expenses as capital assets and depreciating them over time. You can't do that. These policies allowed the company to defer recognizing over $200 million in expenses. Company accountants automatically reclassified any expenditure over $500 as a capital asset. The reclassified assets typically were described only generically, as for example, surgical instruments, medical equipment, without regard to whether they remained in the facility, were used at the facility, or were sent somewhere else or never even used. Again, treating something as a capital asset almost certainly did not follow the general accepted accounting principles. Moreover, the company's approach provided no means of identifying items, even if properly classified, as a fixed asset listing. Just wasn't even appropriately accounted for. The company's operating divisions employed no consistent methodology to estimate or establish contractual adjustments and allowances in the first place. Moreover, even if a particular division had adopted a standard policy for determining contractual adjustments, individual facilities at times calculated the adjustments in a manner that departed from that policy, often with the result that earnings were favorably affected. In 2003, the Securities and Exchange Commission, SEC, accused the company and Mr. Scrushy of inflating earnings to the tune of $1.4 billion since 1999. In November 2003, a federal grand jury indicted Mr. Scrushy on 85 counts, including conspiracy, securities fraud, money laundering, and charges related to overstating HealthSouth's earnings by nearly $3 billion. According to federal investigators, the company overstated earnings to meet analysts' earning estimates while hiding the accounting fraud from the auditors. However, questions were raised whether the auditors failed to find or simply overlooked the fraud at HealthSouth. Central to the investigation was the issue of what role Mr. Scrushy played in cooking the books. However, as the case unfolded, it highlighted many other issues such as the role of the board of directors in corporate governments. What were they doing overseeing Mr. Scrushy activities? The role of the auditors, the effect of conflict of interest between an accounting firm and its consulting arm on auditing, whether the relationship between an investment bank and a company affects the quality of banks' research reports on that company, and whether the executive compensation that overly relies on companies' earnings provides an incentive for committing such fraud, and whether a strong leader can silence all voices of reason in an organization. Furthermore, it highlights the pitfalls in corporate management when the various actors, directors, auditors, investment bankers, company executives work solely in the interest of a few and ignore the interests of other stakeholders. With the issuance of the report of Special Audit Review Committee of the Board of Directors of HealthSouth Corporation, many issues regarding one of the largest corporate frauds in American history came to light. In just a 10-month period of time, from August 2002 to May 2003, HealthSouth went from the nation's leader of outpatient surgery and diagnostic services to a corporate disaster. Its stock, a listing on the New York Stock Exchange, for many years was delisted. 15 HealthSouth employees admitted to criminal complicity in accounting abuses, and Richard Scrushy, the company CEO, was indicted by an Alabama grand jury on 85 counts, including 2 counts on the recently issued Sarbanes-Oxley Act of 2002. SOX, Sarbanes-Oxley Act of 2002, and at the Scrushy's trial would become the first test of this highly publicized legislation. The goal of SOX was to put an end to the era of self-regulation in the accounting environment by creating the Public Company Accounting Oversight Board, PCAOB, which itself reports to the SEC, or Securities and Exchange Commission. Responsibility for developing of standards of auditing of publicly traded companies now rested with the PCAOB. The board is funded through fees charged to these public companies and accounting firms that audit public companies. Inspections of audit firms conducted by the PCAOB also means scrutiny of a larger number of individual auditoring engagements, improving upon the peer review system that had been in place. This increased scrutiny has the potential to lead to second opinions on audit decisions and to even tougher audits. But the impact of SOX was expansive and created new responsibilities for company executives and board of directors, in addition to those for the external auditors. Of primary importance in this case, HealthSouth, are the requirements set forth in Sarbanes-Oxley Sections 302, 404. Section 302 is particularly notable for its new responsibilities set for company executives. Both the CEO and the CFO of a publicly traded corporation are now required to personally certify under threat of criminal liability. 1. The signing officers have reviewed the reports. The report does not contain any material untrue statements or material omission or be considered misleading. The financial statements and related information fairly present the financial condition and the results in all material aspects. The signing officers are responsible for internal controls and have evaluated these internal controls within the previous 90 days and have reported their findings. A list of all deficiencies in internal controls and information on any fraud that involves employees who are involved with internal activities. Any significant changes in internal controls or related factors that could have a negative impact on the internal controls must be reported and acted upon, and it is the responsibility of the CFO and the CEO. The Sections 404 of Sarbanes-Oxley establishes the responsibility of an external auditor to provide an independent opinion to shareholders and the board of directors both on the management's assertion on the effectiveness of companies' internal control over financial reporting and of the effectiveness of those internal controls. In addition to the traditional financial statement audit opinion, prior to SOX, an explicit opinion on internal control over financial reporting was outside the scope of the financial statement audit opinion. This may have contributed to the expectation gap between what an auditor's report was perceived to encompass and what it actually delivered. In some cases, investors believed that an unqualified opinion on the financial statements also indicated that the company was well controlled by management. Hopefully this gap has been closed by Sarbanes-Oxley, and hopefully the example of HealthSouth, among others, WorldCom, Enron, will serve due notice to those CEOs, CFOs, board of directors, auditors, both internal and external, on the importance of having an ethical climate and ethical actions as part of good business sense. Thank you very much. This concludes my HealthSouth report.